Well, hello everyone and welcome. Cynthia Tomaine here with Interactive Brokers, and thank you for joining today's webinar being brought to us by the Singapore Exchange. We're very pleased to have Tariq Dennison with us today for the presentation. So Tariq, thanks for joining us. I'm going to go ahead and pass the controls over to you. If you would share your desktop, let's get underway here today. Oh, it looks great.
Thank you very much. Yeah, it looks like you've got my title slide right there. And for those of you who may recognize, this is a sunset over Victoria Harbor looking from the Expo Center, which was completed shortly before the handover. And the imagery here is looking up towards mainland China from Hong Kong. And that's the H and the H50 are the mainland China companies traded in Hong Kong. And we're really going to be looking at China's next decade, as best as I can present it to you. So China's blue chips in 2021 and beyond. And just as importantly, we want to present this with some actionable strategies on the H50 index and how the H50 compares with the A50 and other Chinese blue chip benchmarks you may be familiar with. Now, first of all, before we get into it, I want to present an important disclaimer. And another disclaimer by SGX. So for those of you who may not know me, a very brief introduction. My name is Tariq Dennison, TEP, CFP. Those letters stand for Trust and Estate Practitioner and Certified Financial Planner. I am an independent advisor and manager of accounts on the Interactive Brokers platform. So if you go into the Interactive Brokers marketplace, or if you look at advisor accounts, basically my firm can manage either your whole Interactive Brokers account or a partition of your Interactive Brokers account if you would like our help with a specific investment strategy. And today I'm really going to be talking about China, and we do have several clients who really want an expert here on the ground to help their greater China portion of their investment portfolios. I've been in markets now for over 22 years, starting my financial career at Commerzbank, based in Frankfurt, but also working in New York and London. I then spent a good chunk of my career at Bear Stearns in New York until it collapsed in 2008 and was taken over by JP Morgan. I moved out here to Asia just over 10 years ago with a Canadian bank, and then later spent 1 year at Societe Generale before starting my own wealth management firm on the buy side. I have a master's in financial engineering degree from the University of California at Berkeley. So I am American, hence the American accent and willingness to support American accounts, even those who want to invest in China. And I'm a visiting professor at Essex Business School, where I teach fixed income and alternative investments. If you would like to look me up, my book is Invest Outside the Box, which is available on Amazon and wherever you get your ebooks. So a quick outline of what we're going to be talking about today. As with all of my presentations, I have the fundamental background part and the action part. So in the fundamental part, we're going to be talking about first, China's place in global and emerging market index benchmarks. Namely, if you right now are buying a world stock index fund, what percentage of that is in China now? What percentage of it was in China 10 years ago? What percentage of it is going to be in China in 10 or 20 years? How important is China as part of a global equity market portfolio? Next, we're of course going to look at the elephant in the room for this year, which is the COVID-19 pandemic, which is about to celebrate its first birthday, or it's currently celebrated its first birthday, depending on where you consider it started. Obviously, I'm going to be highlighting a lot about how Greater China, in particular mainland China, has handled COVID-19 and how its outlook after this pandemic differs somewhat from many other major economies after the pandemic. Next, I'm also going to review China's alphabet soup of stock markets. And this is really a review of the A-share markets versus H-share markets. Those of you who are already familiar with China's stock markets may already know how these work. I'm just going to provide a brief review here for those of you who may be new to China's different equity markets to just tell you what's the difference between a red chip and an H-share and a P-chip, for example. Next, we're going to dive into the index itself, which is the title of today's presentation. That is officially called the FTSE China Index, but for short we call it the H50, as a reminder that the FTSE China Index is actually an index of 50 Hong Kong listed mainland Chinese companies. And we're going to compare it versus two alternative blue chip benchmarks, which is the FTSE A50, which is of mainland companies, and of the Hang Seng Index, which is based here in Hong Kong and used to be more of a Hong Kong index, but is now mostly a mainland index by a competing index provider, Hang Seng Indices. When we get to the action part, the main thing we're going to be presenting are the two different futures contracts that represent the two FTSE 50 benchmarks, the H50 futures, which is the new one listed on Singapore Exchange, versus the more established A50 futures, which many of you may already be familiar with and may have been trading for several years. I'm also going to provide a few samples of long and short trading strategies on these specific futures contracts. Now, first, let's get right into it. The big picture, China versus the rest of the world and versus EM. Where does China fit in terms of the global market picture? One of the first things I think that are worth starting with from a top-down, big picture world investment point of view is that China's representation in the world economy is still very different than how it is represented in world stock market indices. Now, this particular one shows on the top, China is currently about 15.8% of global GDP. And this is nominal GDP. This does not adjust for purchasing power parity. By that measure, China's economy is already larger than the U.S.'s economy. If you look at physical goods produced, physical services consumed, China is already buying more toothbrushes, more computers, more glasses, and so on than the U.S. is consuming. But even just on a nominal currency basis, China's economy is about the same size as the Euro area economy, and together a little bit smaller than the U.S. economy. But if you look at the weighting of the FTSE All-World Index, now we're consistently using FTSE indices here. The FTSE All-World Index is what you have if you buy, let's say, a Vanguard All-World stock portfolio. That index is right now 55% in the U.S., 9.5% in Europe, 7.7% in Japan, and only 4.2% in the world's second largest economy. So just in terms of proportion, one of the reasons to be deliberate about your China exposure is that American investors, for example, have more than 10 times as much of their stock portfolios allocated to Chinese stocks through passive indices that happen to include China than through any deliberate allocation to China and allocation within Chinese markets. So that's where I find relative to the size of the economy, it's well worth understanding this giant of a market and how to better include it in your portfolios, long or short. Now, if we're not looking at the whole world, but if we're just looking at emerging markets, China is by far way too big to ignore. And here, to be clear, I'm only referring to mainland China. I'm not including Hong Kong, Macau, Taiwan, or other parts of what you might call Greater China. But if you look at the FTSE Emerging Market Index, which until recently only included the H shares and Chinese stocks that were listed in New York or Singapore, it was only, or as you might say, 26% of the emerging market index. Now, one of the patterns that we're seeing over these past few years, and we'll continue seeing, is greater inclusion of the China A-share market, which, as we will see, is a much, much larger market. That is the market of Chinese stocks listed in Shanghai and Shenzhen in mainland China of Chinese companies, not just including the ones that are listed offshore. Investors have had greater and greater access to these markets over the years, and that is why FTSE is including them in your stock index. So way too big to ignore, especially after the inclusion. This is the market which is going to represent over half of your emerging market portfolio, like it or not, or it's something you want to make sure you do deliberately. So that was the big picture. Now let's zoom in on the year 2020, and let's see what the COVID-19 shock test was for China. How did this global pandemic, which in a way exposed every country around the world to a somewhat equal test, impact the world's most populous country and second largest economy? Now, as we all know, or as we heard very early on in the year, the COVID-19 pandemic started in Wuhan, China. And initially, if you look at early maps, it was all dominated in China. It was all considered to be a China pandemic. It was, I think, initially considered that it might be a repeat of SARS, since in fact, SARS was also a coronavirus, and the official name of the virus is SARS-CoV-2. So if you look at this particular chart, you see very early on, back in March, China had more cases than all the other major economies combined. And it was only really in March, approaching April, that other countries started having more cases per day than China did. Now, it's worth noting that this chart is on a logarithmic scale. Don't worry, the next chart is on a linear scale so you can see the difference. But the reason I wanted to show you this is it gives you a better zoom in on what the different waves were in a few other major economies. Now, you'll notice here the 4 economies that I chose were GUIC, which is a subset of what I call the juice economies. Juice stands for Japan, US, India, China, and the Eurozone. Together, these represent about 75% of the world's economy and market power. So it's 5 currencies, 5 simple markets that you can use as a measure. And rather than including Japan in this, I decided to leave out Japan, and I only wanted to focus on Germany. We can see that China has more or less got the virus under control. It's down really to about 100 cases a day, which is about what we have here in Hong Kong, which is a tiny, tiny part of China, whereas many other major economies, Germany, India, the US, are still in their second or prolonged first wave with tens of thousands of cases per day by comparison. If we look at it on a linear scale, we'll see there's really no comparison. It's not even close. It's not even funny. If you look all the way on the left side of the chart, that was back in March when markets were panicking, when they realized, oh crap, this coronavirus pandemic is not just a Chinese thing. Cases are starting to mount up in Italy. They're starting to mount up in Germany. Some of the cases have started arriving in the US as well. And that's where we see in April and then later in the summer, these cases really took off in the US, in Europe, and then later on in India as well. By comparison on this chart, China has pretty much almost flatlined since then. And anyone that you know who lives in a mainland Chinese city can tell you how much life has gone back to normal. This, of course, was something that we saw a few months ago, the Wuhan pool party. So Wuhan, the city where it all started, the city where there were reports about the hospitals overflowing and the first cases there, in a way almost wanted to brag to the rest of the world how life there had already moved past the pandemic. Here, of course, you see pictures of the pool party where people are standing shoulder to shoulder without masks. And to be fair, even though this was to some extent a publicity stunt, everyone I've spoken to north of the border has pretty much reminded me of how life has moved back to normal, how within China, everyone has gone back to traveling. My tour guide in Tibet last year, so last summer, me and my family went to Tibet, and my tour guide there had sent me a message at the end of the summer asking me how I was doing. I asked him how he was doing. He said he's had a record year, but it was all domestic tourism for Chinese tourists who weren't traveling abroad and instead had to find ways to travel within China. And for more affluent Chinese, Tibet has been a very, very fashionable destination this year. So these are just some of many images we have about how the life of the coronavirus or life after the coronavirus has been very, very different within mainland China than it has been outside of mainland China. And I can say that even from other Asian cities like Hong Kong, Manila, and Tokyo, for example. So beyond just what we've said in the rest of the world, in the US, part of the story has been the rise of big tech and the resilience of big tech. We've been seeing that this year has been the year of Amazon and the year of Zoom, the year of work from home. And we've seen in the US, this has really benefited big companies, where small companies, if you look at the division between small companies in the US, they've fallen flat, whereas big US companies have done fairly well. The reverse has actually been true in China. If you look at Chinese large caps versus small caps in China have actually outperformed large caps. And part of it is how different Chinese companies are integrated with e-commerce and integrated really with the Chinese consumer. This chart is actually several years old. If you notice here, even the 2017 portion is already in the forecast section. But if you follow, there already was a prediction at that time that China was going to be the dominant retail e-commerce market in the world. This shows you 3 bars showing what percentage of global retail e-commerce was going to be in China, the US, and the rest of the world. And you would expect the rest of the world to be growing as well, but it's just showing you how China is growing that much faster. And if you believe that this year really forced or accelerated e-commerce in a way like you haven't before, if anything, you're seeing it that much more in the difference between China and the US. So another important thing to watch here is the Chinese consumer, and in particular, the Chinese online consumer. In terms of numbers, when we go down to a city level, This one shows you the number of high-income consumers. So not just consumers overall, but this is important to those of us who manage wealth or those of us who sell a higher-end discretionary goods, luxury goods, and you want to know where are people going to be buying them. Of course, all the way on the left, we know of Shanghai and Beijing, and then also Shenzhen, Guangzhou. But according to this, the number of affluent that we have in the second and third tier cities across China in 2015 is nothing compared to what we should expect to add from 2016 to 2030. Again, this is a slightly old chart, but what we've seen, I believe, after this shock test is that there's nothing really in play that seems likely to derail this. Now, of course, I may sound like an unabashed China bull. I will be quite qualified in which sectors I look at and in which sectors I think are better to invest in than others. I will be very cautious on anything having to do with investing in property or infrastructure, which is not being quite as heavily used, or any sector that relies very, very heavily on debt. But for anyone who is actually building up on the higher income consumer who earns a cash salary, these are numbers that are just nothing short of breathtaking and something you definitely don't want to miss out on as an investor. Or if you think it's going to collapse, something you don't want to miss shorting either. We'll talk about that later. So that's on the fundamental side. Now let's talk a little bit about the markets. So we're first going to review the alphabet soups, as I mentioned, of China's different stock markets, and then we're going to be looking at the FTSE indices that represent them. So first of all, China's A, B, H, P, S, N. This is like, how do you keep track of all these different ones? Well, here we have a table from FTSE Russell, which just broadly gives you a brief outline of how to think of them. Now, the short answer is whenever you think of A or B shares, these are the ones that trade and list in mainland China. Now, what's the difference between an A share and a B share? The A shares trade in local currency. They trade in Chinese yuan, renminbi, in Shanghai and Shenzhen, and initially they were only available to mainland Chinese investors. In 2002, these markets first opened up to qualified foreign institutional investors, QFII, with a specific quota. Later on, in 2011, to an RQFII, a renminbi qualified foreign institutional investor program, which was a little bit more open but limited to Chinese firms. And then since 2014, a pair of Stock Connect programs, which now allow anyone with an interactive broker's account to trade Shanghai and Shenzhen listed shares through the northbound trading link from Hong Kong to Shanghai and Hong Kong to Shenzhen. So this is the A market, the A50 that we're going to be talking about first and foremost. There is also a B share market, which trades in mainland China, but in foreign currency, in US dollars or in Hong Kong dollars. And this market has really faded. It's nowhere near as important as it used to be. And we'll see from its statistic, we can probably more or less ignore it now. Where it's really taken over is the H share market here in Hong Kong that trades in Hong Kong dollars. And for decades, this has been the main way that foreign investors have accessed mainland Chinese companies. If you wanted to trade Tsingtao Brewery or Bank of China or PetroChina, yes, some of those names would have traded in New York, but you probably would have traded them here in Hong Kong during China hours. And so they were available to foreign investors, and then mainland Chinese had something called a QDII program. So QDII is a qualified domestic institutional investor, which allowed mainland Chinese to buy foreign stocks. Now, in addition to QDII, there is also the Stock Connect program, which allows mainland Chinese to buy Hong Kong listed shares in what's called the Southbound Stock Connect. If you are interested in the Hong Kong market, you should follow the Southbound Connect schemes as well, because those mainland flows can really drive the shares of Hong Kong listed shares relative to A shares quite quickly. Two other categories of shares that also trade in Hong Kong, which are technically not A shares, are red chips and P chips. Now, the real difference there is what are those companies? Who owns them and what do they represent? By definition, a red chip is a company that has a minimum 25% ownership by a Chinese state entity, by a Chinese state government, by the federal government, by SAFE, by some government-controlled entity, and that's the red in the red chip. It implies a level of ownership, scrutiny, and control by the Chinese government. By contrast, P chips are privately owned. They're private ownership. They're typically incorporated in places like Bermuda or the Cayman Islands, and a minimum of 45% of their revenues must come from the People's Republic of China, and a minimum of 45% of their assets need to be located in the People's Republic of China. Last but not least, you may also hear of S-chips and N-shares. S-chips are Chinese companies listed in Singapore, while N-shares are the ones you're probably familiar with, Alibaba, JD, that are listed and trade on U.S. exchanges. Now, of course, there's a lot of political controversy around Trump's latest executive order or about requiring N-shares to get U.S. audits, which I'm sure I may get some of in the questions and comments section. But for now, this is your cheat sheet to that alphabet soup of Chinese share classes. Now, for anyone who might have thought, Chinese stocks are all the same, even by these categories, without even breaking down the difference between PetroChina and Baidu, we can see that these different categories as a group have performed really quite differently. I mean, there's quite a bit of divergence in their performance. Where on the top, we can see that the H-share, all caps, have done quite a bit better than, say, the B shares or the red chips, just by comparison. And a lot of this really comes down to what these indices include. B shares and red chips, of course, include a lot of state-owned enterprises. Many of them are really managed for the benefit of the public, really more than for the benefit of shareholders. That's something which, as a stock investor, is something worth keeping in mind. If you look down at the bottom, you will look at the P chips and N shares. Those have performed even better than any of the H shares or A shares that we saw earlier. But also a lot better than the S chips. The S chips have had, unfortunately, a nasty reputation for being largely junky companies. Whereas when you think of the N shares, you're thinking of the FANG stocks of China, the Baidu, the Alibaba, the Tencent, the e-commerce companies, which felt that they could go over to the U.S. and capture the U.S. attention. Now, that's not to say that there aren't the cases of Sino Forest and Luckin Coffee, which are also in that basket as well. So that's, again, the importance of buyer beware and the importance of doing a degree of homework and not just buying a good story when you see it. Some statistics on the relative size of these markets. I've included the link below to where you can go on the Hong Kong Exchange to get updated versions of this. This was updated on the 25th of November, showing the relative size of listed companies, red chips, and H shares on the Hong Kong Exchange versus the number of shares listed in Shanghai or Shenzhen. One of the first things that may pop to mind is the relative amount of the turnover versus market cap. So what you'll notice is that even though these three markets have roughly the same market cap, the Shanghai and Shenzhen exchange have much higher trading volumes. In other words, domestic Chinese investors simply trade a lot more, or at least they trade over twice as much as investors in Hong Kong or that trade on Hong Kong exchanges. You'll also see the difference in the PE ratio, noting that the Shenzhen listed shares trade at over twice the earnings multiple as the Hong Kong or Shanghai shares. Again, there are different reasons for those that we can go into when we break down the indices. When we look at companies that have both A and H shares, now this is varied over time, and we'll see on the next chart by how much. Right now, when I last looked at this, without exception, every company that has both an A and an H share, the A share is more expensive. In other words, the A shares trade at a premium to the two H shares, some by pretty significant amounts. So, for example, here, if you look at Zhejiang Shibao, the H share trades at an 83% discount, meaning the A share trades at over 5 times the valuation. You can see right here, 1 Hong Kong dollar for the H share versus 5.5 RMB for the same company. So some of these can trade at pretty ridiculous spreads if you go a little bit further down the list. That said, it really isn't the arbitrage in the other direction because you can't really sell short these individual A shares. The A50 futures, which I've presented before and I'm going to be presenting again later, is one of the main ways that investors take short positions in at least an A share benchmark. And we're going to be showing this as at least as one way of doing an A versus H long-short future strategy in a little bit later on. But I want to make sure that it's clear this is where you can look at the AH premium and know that it's not exactly an apples to apples. This index is from Hang Seng. I'm not sure if actually FTSE has a similar index, and you'll know it's stitched from 2 different ones because when I go to the Financial Times only shows me this going back 5 years, but I've been doing this presentation for several years now, so I have this data going all the way back to 2013 and late 2014. It was in late 2014 that the first Stock Connect scheme was announced. What that meant was that investors in Hong Kong could easily buy Shanghai listed shares from their Hong Kong brokerage accounts, But it also meant that Shanghai investors could also buy Hong Kong listed shares through southbound Stock Connect. Now, what do you think happens when suddenly an investor could easily trade either one? In theory, you should buy the one that's cheapest. But what happened at that point was one of the rare times that A shares traded at a discount flipped up to a premium. And ever since then, I have almost never seen, or I don't think there's ever been a time that A shares have on average traded at less than a 15% premium to the same H shares. Now, you want to look at how this index is calculated, but when I checked it recently, this premium has gone up even further. It's now at about a 40% premium on average across the board. So even though I showed you that the same stock trades at very different prices in Shanghai versus in Hong Kong, that doesn't mean that there's an immediate arbitrage. So watch this premium and know that that premium can stay high for much longer than you or I can remain solvent. So now let's dive into the index itself. We talked a little bit about the A and the H share markets. What is this H50 index that SGX thought was worth launching a futures contract on? Well, here is really the detailed answer to it. This is a spreadsheet, which some of you may prefer to get in Excel, but here it is on a PowerPoint slide showing you the 50 components in the H50 index, their relative weighting, and I've also compared side by side those that have A shares, what is the A share and what is their weight in the A50 index, what is their premium, the H premium or H share discount, and then also just so you can compare side by side, does the same name appear in the Hang Seng index? And then just so you have it there, is this company a P chip, an H share, a P, a red chip, or so on like that? Just so you have samples. This table is very, very, very useful. I print it out and I keep it on my desk as a cheat sheet. But really what this is meant to tell you here is there is not that much overlap. I mean, there's some overlap, but there are a lot of names in the H50 that are not in the A50. If you look in the A50, you'll see a lot of names in the A50 that aren't in the H50. There's not really a lot of overlap with the Hang Seng index as well. So be careful when using one as a proxy and know that if you are, say, going long H50 and short A50, you are taking a discrete bet on, say, Meituan Dianping over Guiqiao Maotai. These are two different names. One is in one index and not in the other. And, so be aware. China Construction Bank is one where, say, the difference in the A50 is weighted very differently than in the Hang Seng or the H50. So this at least is an initial cheat sheet to let you know what you're getting in this H50 index. Those of you who follow ETFs may be familiar with the ETF FXI. That is one other place where you can get a source of the H50 index. That tracks the FTSE China H50 index as well. Now, in terms of sector weights, are there sectors that we see represented very, very differently in one or the other? Well, the short answer is yes, absolutely. We saw with the case of, say, Meituan Dianping and some of the other tech names that are listed here that don't have A shares. The biggest difference I always point is the A50 really is a financials-heavy index. So this has shifted a little bit as the banks have underperformed. For most of the time I've watched the A50 was roughly 50% in financials. We now have 23% in consumer staples. A large chunk of that is in two liquor companies that I'm going to be highlighting later. Now, the H50 does not have liquor companies, doesn't have the staples, but it does have discretionaries. So these are things to watch in terms of the relative sector weights. Also, when you look at communications represents a much higher weight in the H50 than in the A50. You may want to compare this sector by sector. You may want to compare it name by name. You may be comparing valuation ratios. But these are just some of the cheat sheets that you can use when comparing one sector versus another. Now let's look at the very top. You'll notice that if we looked at the top of the H50, we saw a few names that had really, really high weights. Meituan Dianping, for example, was about 10% of the index. Tencent, Alibaba, very, very high weights in the index. And Alibaba, for example, very famous, where about a year ago, they went from being just listed in New York to now also having a listing here in Hong Kong. Huge e-commerce company, completing really what you think of as the tech giants of China. In addition, we also have Wuxi Biologics, which is more of a biotech company, and Xiaomi, which is a hardware company. Xiaomi makes mobile phones and smart scales and the little smart health tracker, heartbeat tracker that I'm wearing on my wrist right now. Xiaomi is really aiming to be a smart home Internet of Things device company. whereas Meituan Dianping is really very much on mobile commerce, online. Tencent, of course, owns WeChat. Basically, if you're looking for the equivalent of the FANG stocks in China, the H50 has the top of them now. Now, if we were to look at them on a market cap basis, we're really talking about different leagues when we're looking at, in this case, Alibaba and Tencent versus the other three. Alibaba and Tencent are really the two giants. Even though Meituan Dianping is the largest component of the index, do keep in mind it's only a third of the size of Alibaba. It's still a much, much smaller company, and it rocketed up there very, very quickly. Whether that gives you a bull thesis or a bear thesis, I will leave up to you. But I think it is important when you just look in the weights of the index, do keep in mind of what it is that you actually own in there, how it got there, and where it's going from here. Xiaomi and Wuxi Biologics are much, much smaller companies by comparison. But let's see on the next slide, how do they compare in terms of revenue growth and in terms of earnings growth? Now, I say roughly equals to free cash flow roughly. The nice thing about these five tech giants is their net income and their free cash flows for the past few years have actually been roughly similar. We don't see huge differences between earnings and cash because they're really largely free cash flow generating companies. And again, Tencent and Alibaba are in a league of their own, and the other companies really are much smaller, both on a revenue basis, but especially on a net income basis. Those of you who followed my earlier webinars know that I'm biased towards companies that make money. I don't like companies that have spectacular revenue growth and very, very little profits. But so that's something that I'm going to be looking at when I look at individual companies, something to put in your models when you're modeling the index. When you look at valuation multiples, since these are largely growth companies and we've seen how thinly profitable a few of these companies are, I do think one of the better comparisons is just looking at the price to sales ratios of these companies. Now, again, if you look at the giants at Tencent and Alibaba, they look expensive but relatively stable, always trading at somewhere between 8 to 12 times sales. Meituan Dianping has rocketed up recently, but looks nothing as wild as Wuxi Biologics. So just comparing side by side, this is what the valuations of these companies look like on a relative basis. The reason Xiaomi may look so cheap, don't forget, Xiaomi is a hardware company. Hardware is just by its very nature much more capital intensive and going to be lower margin and is going to trade at lower price to sales ratios than the software tech giants. Now, let me look at the flip side. When we look at what is in the A50 that's not in the H50, and this is important, if you're going to take, let's say, a long A50, short H50, or vice versa, you're going to want to know what's in one and not the other. Two of the top components that I mentioned earlier that are in the A50 are liquor companies, Guijiao Maotai and Wuliangye Yibing. These make very highly alcoholic spirits, usually around 60% alcohol from sorghum. And many of these spirits they sell for around $300 a bottle. The Wuliangye bottle, you'll notice on the right, has anti-counterfeiting measures in it. If you've spent time in mainland China or have gone to a mainland Chinese banquet, you know that these are, in effect, some of the main luxury goods that you will see at a Chinese banquet or a Chinese state event. They're wildly profitable companies, and they've worked their way to the top of the indices. One of my great regrets is actually selling my Guijiao Maotai shares way too long ago. I bought them in 2014, right when Stock Connect started, and I took profits too early. By comparison, three other companies that are worth noting, now I've left out financials on purpose, are Gree, which makes air conditioners and a lot of other home appliances, Jiangsu Hengrui, which you may notice the logo looks a little bit like Pfizer. It's a pharmaceutical company, and Yili Dairy on the lower right-hand corner. That's a dairy company, a milk company. Quite unlike many other emerging market indices, which very much have resources and banks, there really are a lot of other quite interesting companies here worth looking at. So I highly recommend studying these indices if you're interested in the world's second largest economy. So a brief summary of the H50. It really is topped off by the tech giant P-chip companies, the Tencent and Alibabas that we've noticed. But it also contains red chip companies like CNOOC and China Mobile. On average, the H50 companies, when I looked at that discount column, has an average of a 35% discount to the same company that you see in the A50 index. So just on a pure AH discount basis, there's a 35% discount there, but remember from the chart, that doesn't mean that discount can stay there. Now, compared with compared with the Hang Seng Index, there's actually slightly more overlap with the Hang Seng Index than there is with the A50 Index, roughly a 50% overlap. Again, because the H50 does not include any Hong Kong shares. It has been mentioned that I should have compared it with the HSCEI or H share. The reason I compare it to the Hang Seng is that more people are familiar with it. You see it in more newspapers. And so, yes, you're right. You can compare it with the Hang Seng H share, but there's still a 50% overlap even with the Hang Seng Index. Now, if we look at the A50, just for comparison, the top companies, don't forget, are Big Liquor and other domestic names, which I've mentioned, like Gree and Yili. More of the weight in the A50 is in financials and state-owned enterprises than in the H50. So another factor to keep in mind. Now, there is a 38%, now going the other way, there's a 30% overlap with the names in the H50. Now, that's different than with the weights and the components in the H50. And there's another 7% of H50 names with A shares that are not in the A50. So if you look at them side by side, you look at all 50 components in the A50, all 50 components in the H50, you'll see which ones are left out on either side. So again, that cheat sheet I gave you should be a good starting point. Now let's get to the actionable stuff. Now let's look at trading mechanics and strategies that you can actually put in place in your interactive brokers to play on everything that I've just told you. So first of all, you're probably going to ask me about this new contract that SGX just launched. Where do I find it? Well, here it is. Here's the ticker, XINA 50, China 50, if you want to call it, Xinhua 50. Trades on the Singapore Exchange. You can go and find it. You can see that the index is right around 16,000, and the contract multiplier is $1 US. It is a US dollar denominated contract. Contract size, you might say, is relatively small for indices that go. And if you look on the lower right, you'll see roughly what the initial margin is. I do not recommend anyone push their margin limits. So I'm not showing you the margin limit so that you can maximize your leverage, just really to give you an idea of what the contract size is and what this would look like if you wanted to buy or sell. You notice that in this example, I'm showing a sell contract because many of the strategies I like are buying individual stocks and using short positions in these futures as a beta hedge. By comparison, you'll notice the difference in the tickers when I go from here to here. This is the, that first one was the A50. The second one here is the H50. XINOI, sorry, my mistake here. This is the new contract. The last one, the A50, was the A50 contract. This one here, the FTSE China H50, is the new contract, the XINO0I, and that index is currently around 20,000, but this contract size is slightly larger, is $2 US per point, and you can see again the margin limits here. Again, I show you the margin limits in the sample if you were to sell one contract. Those of you who understand how futures contracts work, long or short, it's going to be pretty straightforward and something that you can include in your overall futures trading strategies. If you go to the SGX website, you will probably get a little bit more of a snapshot in both the T session and T+1 sessions. I don't get terribly put off by this because what I really care about on a futures contract is, do I get the price that I want? I go in and I put in a limit order at the level I want. If I get filled, great. If not, I'll move on and probably trade somewhere else in another day or two. When I took this screenshot, there was an open interest of only 10 contracts, a volume of 27 traded in and out that day. I'm expecting this is going to pick up because don't forget, this contract is brand new. So while I'm sitting here in Hong Kong and every day I'm going to be comparing the H-share contract versus the H50, I'll be watching and seeing if this FTSE index is one that I'll be trading more often. Now, by contrast, those of you who've been following for a while know it's the A50 contract, which has been far more liquid and traded far more heavily for far longer. So you see here, the volumes are in the hundreds of thousands of contracts because for most of us outside of mainland China, this has been the benchmark. This has been the way that we can beta hedge our A-share exposure. So that's what we've got. Believe it or not, here in Hong Kong, there was a CES 120 contract, which was a blend of H and A futures, and it never really took off here. So, home run Singapore, you've had a good contract here that we all end up using. Now, two specific strategies. This first one is the one that I mentioned I use quite often, which is cash positions in H shares and using an H share futures contract as a beta hedge. So in other words, I'll buy stocks and I will sell futures with the view that my individual stock picks are going to outperform the broader market. This is a classic alpha beta cash versus futures strategy. And it's also a relatively efficient way to short hedge your broader market exposure. Any of you who've tried selling short an individual stock in Hong Kong know that it's possible, but it has a little bit more hair on it than trying to sell short, let's say, a US or UK listed share, especially when you're worried about a stock getting halted. Now, one of the things you're going to want to compare is this futures contract, is this an appropriate benchmark for you? You know, is this better than, say, selling the A share or selling the Hang Seng as your beta hedge? Now, what are the risks in this strategy? I've described this as the ideal long-short alpha strategy. But of course, the biggest risk is just being wrong. You know, yes, I picked stocks I think are going to outperform the market, but if the market goes up and my stock picks go down, I will lose money. And if I push my margin limits, I'm going to get wiped out. So this is something to watch out for when you are doing any strategy like this, whether on the long side or on the short side. Also, do note there is a bit of currency basis here because the Hong Kong stocks that I'm going to be buying trade in Hong Kong dollars, and the index, the H50 index, trades in US dollars. There's probably not going to be that much of a difference, but there is a basis. And it's not going to, in my view, it's not going to be as significant as the A50 basis, because remember, the A50 is a renminbi denominated index, and the futures contract trade in US dollars as a quanto. Now, also for those of you who need liquidity, do keep in mind that the H50 futures liquidity may take some time to develop. And that is the reason why, of all the future strategies I'm mentioning today, I am not showing you a momentum strategy. I don't do momentum strategies on futures contracts that aren't liquid like water. Next strategy is the one that I mentioned a few times earlier, trading the A50 versus the H50 as a pair trade. Now, in terms of contract size, we're looking at a roughly 3-to-1 contract ratio, 3 A50 futures for every 1 H50 future, so that you have roughly the same dollar amount on each side. Those are the contracts are denominated in US dollars, which make the trade fairly easy. Now, even though you might think initially, oh, this is just a play on the AH premium, as I've shown you, the reason I spent so much time showing you what's in the index is because this pair trade is implicitly an offshore technology versus onshore staples and SOE trade. So you are really with this trade making a sector bet just as much as you are making an AH premium bet if you're trading one versus the other. Now, again, the nice thing about futures, you can go long one, short the other. Either way, that is entirely up to you. It's just as easy. You don't have to worry about borrowing shares. Now, what's the risk with this? There is supposed to be some margin offsetting. You'll have to ask the exchange or interactive brokers in terms of how they do it. But the problem with margin offsetting is that it'll tempt you to push your margin limits more than you probably should. So I'm conservative. I often suggest you do the same. There also is a basis between the renminbi quanto versus the Hong Kong dollar on the currency side. Probably not going to affect you on two relatively stable currencies like this, but again, a risk factor to watch out for. And just as importantly, I put this right across from the thesis of this trade is a pair trade of offshore technology versus onshore staples and SOEs. If you are wrong, you can lose a lot of money. So watch your thesis and watch your margin limits. So that was my attempt to whirlwind present all of those main differences, all those main highlights between A's and H's. I'm going to go ahead and go to the question section right now. So as Cynthia had pointed out, you can go to your questions panel to ask any questions. I will be here for a few more minutes, but I do need to run shortly. Cynthia did mention that there may be a delay in sending you a follow-up email, but we'll try and send you a follow-up email so that any questions that get gathered later on, I will try and send you the follow-up email. Please see on this final slide my contact details, including with my WeChat, my email, my website, and my Twitter, for example. I will go ahead and try and answer the first few questions I see in the question panel before we get going. So first here, okay. So the first question was, is there time to quickly show us how to trade A shares and H shares through the IB platform? And I'm guessing what you mean here is you mean cash A shares and cash H shares. So here, I don't really have the screenshots up, and I don't have interactive brokers up and running. But the simple way really is to just pull up ticker. When you go to Trader's Workstation, let's say you go to Trader's Workstation, you pull up a line, you want to pull up a ticker. So I've given you the tickers in the cheat sheet, or you can look up there. You go type one in, and you'll see, Bank of China, whichever company you're looking at, You pull it up there, and then once you've got the line, you can click the buy or sell button in just the same way. Same exact thing with A shares. If you type in the ticker, you get Guizhou Multi, Wuzhanye, and then you can click buy or sell there as well. So hope that's straightforward enough. By all means, feel free to send me a follow-up if you want some of my screenshots for my trading session tomorrow. Question number 2, how does the high endemic leverage across the Chinese economy impact stock market returns? So short answer of leverage is leverage acts like lighter fluid. It lights it up on the way up, but it also makes crashes, or it makes bear markets that much more spectacular. So leverage, as you know, is a double-edged sword. And so that's why I mentioned earlier, when I look at Chinese companies, now again, this is my view, this is my house view, not everybody agrees with me. I am very careful about avoiding Chinese companies that are exposed to large amounts of leverage. So to take one example, Chinese property developers, they represent a very high share of the large cap companies listed here in Hong Kong. The problem they have is that they not only borrow a lot of money, they sell something that is purchased with borrowed money. So if you were worried about high amounts of debt, that is a good example of a sector that you probably don't want to avoid, or that you probably don't want to overload on. On the other hand, if you believe that that leverage is going to continue and there's going to be support at whatever cost, those highly leveraged companies are going to outperform the not so leveraged companies. So simple answer is leverage will multiply your beta. Just like lighter fluid on your barbecue, please use it carefully. Next question, can we trade A shares on IB platform? Yes, absolutely. There's northbound trading links for both Shanghai and Shenzhen. I have traded several A shares that way, just right in the cash account. I do believe you need to have the permissions set up. I think there might be a slightly different permission there. I might also leave to Cynthia if she has any other details or platform-specific things she want to answer there. But yes, I've traded A shares in my Interactive Brokers account. Thank you very much for enabling it. What do I think about Ping An shares about it as an investment? I am going to decline answering on specific companies here, but in general, my concern about Chinese financials in general is that they historically haven't been terribly shareholder friendly. Many of them do trade at discounts to book value. I haven't checked out Ping An lately. So what I would say is if you invest in any financial anywhere, make sure you understand what's really on the balance sheet. I have a much harder time understanding what is on the balance sheet of Chinese financial companies than I do of, say, Canadian financial companies. And it's not as though Canadian banks are the most transparent either. So I really would rather not go into any more detail on that, but my recommendation there is please make sure you understand the balance sheet. And that's my brief view on there. What currency can we trade A shares? A shares trade in offshore renminbi. They trade in CNH. So that's what you will see there. If you don't have those, I don't know if there's a margin or other capability there. The way I've always done it is I've converted currency into offshore renminbi, into CNH, bought A shares that way. That's how they trade. That's how the Stock Connect works. Thank you again for asking. So good. I think that's a good sum up there. If that's okay, Cynthia, can we go ahead and wrap up? And any other questions we may get further on, I'll go ahead and answer them in a recap afterwards.
Okay, well, Tariq, thank you very much for an interesting and informational presentation. Now, I do want to point out, if anyone does want a copy of the slides, notice the handout pane that's available over on the right-hand side of your screen. You can simply download today's presentation that includes the slides that Tariq has been using. Simply download before you do exit today's session. Now, I do want to point out that if you are interested in trading these products, you'll find that they are available under the or on the Interactive Brokers website. Go underneath the trading menu into exchange listings, where you can find the Singapore exchange and all of the products that we do have available. And those that are interested in the Stock Connect program, you'll also find underneath the Hong Kong exchange, we do have listings for the Shanghai and Shenzhen Stock Connect program as well. So you can drill down there. With that, I also do want to mention that we have been recording today's session. Now, typically we've been sending out follow-up emails, but are not able to at this point. So I do want to point out that you can access today's recording. You'll find it listed, again, on the Interactive Brokers website underneath the Education menu. Simply go to the Webinars section and click on Recorded Webinars, where you can find today's presentation and also all that Tariq has been doing underneath the you can find that underneath the Industry Sponsored tab. So with that, we are going to conclude our session here this afternoon. Thanks very much for Singapore Exchange in making today's presentation possible, and much thanks to Tariq Dennison as well. Also want to thank all of you for taking time in your busy day to participate here this afternoon. You can all exit using the X in the upper right-hand corner of your screen. Have a great rest of your day, everyone, and thanks very much for your participation here this afternoon. Have a good one, all, and thank you.